There is a moment, and you may have already lived it, where you are sitting at the kitchen table with your super statement open in front of you, reading glasses on, a cup of tea going cold beside the saucer, and somewhere on page 3, in a font so small it seems deliberately chosen to discourage reading, you see the words tax components. Something tightens in your chest, not because you do not understand tax, you have paid it your entire working life, but because you sense that this particular tax, the one inside your superannuation, follows rules nobody has ever bothered to explain clearly. You are right, it does. And the most important change in those rules happens the day you turn 60. That is what we are going to walk through today. Not just how the rule works, but why it matters more than you have been told, and why your brain has been making this feel far more complicated than it actually is. I know a bloke, mid-60s now, retired about 18 months ago, who spent close to 40 years in the building trade, ran his own business for the last 20, quoted jobs in his head, managed apprentices, handled the BAS statements and the GST himself. This was not a man who struggled with numbers, but when he turned 60 and his accountant mentioned that his super tax situation had changed, he nodded along the way you nod when someone tells you something you feel you should already understand. He went home that evening, sat down at the desk in the study, the room that used to be his daughter's bedroom, still with the faded marks where the posters once were, and he typed super tax at 60 Australia into Google. What came back was a wall of jargon. Taxed element, untaxed element, preservation age, condition of release, tax-free component, low rate cap. He closed the laptop, made a cup of tea, told himself he would come back to it on the weekend. That was 3 years ago. He still has not come back to it. Not because he is lazy and not because he does not care, but because the system presented itself in a language that made him feel like he was missing something everyone else already knew. The truth is, the change that happens at 60 is one of the best things in the entire superannuation system, hidden behind some of the worst communication you will ever encounter. His wife asked him about it once, over dinner, plates cleared, the financial advisor's annual review letter sitting between them on the table. Did you sort out that tax thing with the super? He said yes. He had not. And here is the part that matters, not the procrastination, but the reason behind it. When a system makes you feel incompetent in a domain where you should feel capable, your brain does not respond with curiosity. It responds with avoidance. You push it away. That avoidance is not laziness. It is your brain shielding you from information that threatens your sense of competence. He could price a renovation to the dollar, but the super system made him feel like a beginner, and his brain refused to sit with that feeling. If that sounds familiar, it is because the system does this to almost everyone. So here is what actually happens to your super tax at 60. And I want you to pay close attention because this is one of those rare moments where the news is genuinely good. And the fact that it was never explained clearly has probably cost you years of peace of mind you did not need to lose. When your employer puts money into your super fund, the super guarantee, currently 12% of your ordinary earnings under current legislation, that contribution is taxed at 15% inside the fund. Not in your hands, inside the fund. So if your employer contributes $10,000, the fund keeps $8,500 after taking $1,500 in tax. That 15% applies to all concessional contributions, employer contributions, salary sacrifice, and personal deductible contributions up to the concessional contribution cap of $30,000 per year. And while that money sits in your fund in the accumulation phase, the phase it stays in while you are working and building your retirement savings, the investment earnings are also taxed at up to 15%. So during your working life, your super is taxed twice. Once on the way in, once on the growth. Here is what that feels like from the inside. It feels like you are building something solid, brick by brick, year after year. But someone is quietly removing a brick from every row while you're not looking. You cannot see exactly how much is being taken because it is all happening inside the fund, buried in annual statements written in language that resists understanding. And so you develop a quiet unease, a sense that the tax office is always reaching into your super balance and you're never quite sure how deep. That unease is not irrational. It is the natural response to a system that takes from you in ways you cannot fully track. Now here is where 60 changes everything. Under current Australian tax law, confirmed directly by the Australian Taxation Office, once you turn 60 and access your super, whether as a lump sum withdrawal or as a regular income stream from an account-based pension, the money comes out completely tax-free. Let me say that once more because it deserves to land. Tax-free. No income tax on withdrawals, no tax on lump sums. The money you take out of a taxed super fund after 60 does not appear on your tax return as assessable income. For the vast majority of Australians whose super sites in standard employer funds like Australian Super, Aware Super, Host Plus or Rest Super, this applies to almost their entire balance. It is, under current rules, the single most generous tax advantage most Australians will ever receive. Picture this, because you may have lived it. Say you have built up 400 grand in super. You turn 60. You retire or meet what the ATO calls a condition of release. You start drawing $30,000 a year from your account-based pension. That $30,000 arrives in your bank account and you pay zero income tax on it. Compare that with $30,000 earned from a job, where you would pay thousands at your marginal rate. The difference over a decade of retirement is enormous. And here is the psychology nobody talks about. After a lifetime of being taxed on every dollar, your brain has built a deep rule. Income means tax. When someone tells you this income is tax-free, your brain does not celebrate. It hesitates. It waits for the catch. You check your tax return twice. You ask your accountant to confirm. That is not ignorance. That is a pattern built over 40 years of learned caution. Trusting that the money is genuinely yours requires your brain to override decades of conditioning. That takes time. And that is perfectly normal. But there is a second change at 60 that is equally powerful and even less understood. When you move your super from accumulation into a retirement phase pension, the earnings inside the fund also become tax-free. During accumulation, the fund paid 15% on investment returns. In pension phase, that drops to zero. The growth, the dividends, the interest, untaxed. This is capped by the transfer balance cap at $1.9 million under current legislation. Anything above that stays in accumulation, taxed at 15% on earnings. But for most Australians whose super balance sits well below the cap, every dollar of earnings in pension phase is tax-free. In real terms, $400,000 earning 6% produces $24,000 in returns and not a cent of tax. In accumulation, you would have paid up to $3,600 on those same returns. Over 15 years, the difference compounds into tens of thousands of dollars staying in your account instead of going to the tax office. And yet many people hesitate to move their super into pension phase even when they understand the maths. They worry about paperwork. They worry that starting a pension somehow locks them in, even though an account-based pension lets you adjust payments or withdraw lump sums at any time. This hesitation is status quo bias, the deeply human tendency to leave things unchanged even when the change would make you measurably better off, because the familiar feels safer than the unknown. Your super sitting in accumulation, taxed at 15%, feels like the known quantity. Moving it to pension phase at 0% feels like a decision you could get wrong. Recognizing that pattern in yourself is not a weakness. It is the beginning of choosing based on what the numbers say rather than what your anxiety assumes. So here's what you can do. First, log into your super fund or check your latest statement. Look for the tax components section, specifically the taxed element. For most people in standard employer funds, the vast majority of your balance will be this component, which becomes completely tax-free on withdrawal after 60. Second, if you're over 60 and your super is still in accumulation, contact your fund about starting an account-based pension. Many funds, Australian Super, Colonial First State, Uni Super, have dedicated retirement planning teams who will walk you through it on the phone. Third, if you want independent guidance, a qualified financial advisor can map your specific situation, your super balance, your age, pension eligibility, how the income test and assets test interact with your pension income stream, and show you exactly where the pieces fit. The ATO website has sections called Super Lump Sum Tax Table and Income Streams from Super, both written more plainly than most fund communications. And Services Australia can show you how your retirement income interacts with Centrelink thresholds for pension eligibility. Most importantly, give yourself permission to believe the good news. The tax-free treatment of super after 60 is not a loophole. It is the deliberate design of the system. Your money was locked away for decades, taxed at a discount going in, and in return, when you reach 60, withdrawals are tax-free. You held up your end. The system owes you this. Do not let the opacity of the language stop you from claiming what was designed to be yours. There is a deeper layer beneath everything we covered today. The way your brain handles the shift from building your super balance to actually drawing it down. That transition from wealth preservation to spending triggers something in nearly every retiree that goes beyond tax strategy. It connects to how your brain defines financial security and what it means to have enough. That is something we go deeper into, and it is worth understanding. If this made something clearer that felt confusing before, you might want to stay, because there is a lot more to untangle about retirement income and super drawdown strategy, and it gets clearer from here. I am curious. When did you first realise that the tax inside super worked differently from the tax on everything else? Did someone sit you down and explain it, or did you have to piece it together on your own?